What's up, everyone? There's a brand new ETF that's been getting a ton of attention. So much so because it's up 12.9% over the last 6 months. It pays a weekly distribution of nearly 80% annually, and it's tied to one of the hottest alternative markets anyone can invest in right now. But the real question is, can it actually hang with two of the hottest and most trending high yield ETFs on the market today? We're going to compare it to HOW and ULTY, because those two have dominated the conversations around weekly pairs. And if this new fund can't hold its own, it doesn't matter how high the yield looks. If I've piqued your interest, let's get it started now. Welcome back, guys. Rico here, and today we're digging into, drumroll, YETH, the Roundhill Ethereum Covered Call ETF. And by the end of this video, you'll know how it stacks up against HOW and ULTY, and which of the three might fit your goals best. Before that, this is for education and inspiration only. I'm not a financial advisor. Always do your own research before investing in anything. Definitely words to live by for sure. Okay, so let's start with the basics. So YETH, again, it's the Roundhill Ethereum Covered Call ETF. The price as of this recording on Thursday, September 25th, is around $25.47, and the yield is hovering right at 80%, 79.9, which equates to roughly $20.36 per year per share. It has 96% expense ratio, and it's up almost 18% in total return in the last 6 months compared to 16% for the S&P 500. And I wanted to share this words straight from the prospectus. So the fund seeks to achieve its investment objectives through the use of a synthetic covered call strategy. And also, keep in mind, the fund does not invest directly in Ethereum, so you're not actually holding Ethereum. Instead, YETH invests in Ethereum ETFs and Ethereum ETF options, along with short-term treasuries and money market funds. By selling call options, it generates weekly cash flow, but caps upside. So really important for us to know that it's not just holding Ethereum ETFs, but it's also in treasuries and mutual funds, and that's how they balance out the portfolio. So with crypto, there's definitely volatility, and you can start to balance that out with treasury and money market and mutual funds. So that's how they can also maintain their distribution, just as a heads up. Okay, now let's look at HOW, which is the Roundhill Hood Weekly Pay ETF. Price as of the recording is $71.37, and the yield is right around 76.22%, which equals an annual payout of about $54.40. And the performance so far, it's up 65% year to date, far outpacing the S&P, which is again up only 10% for the year. And then HOW's weekly income engine is fueled by Robinhood. It's one of the hottest stocks and one of the most volatile names right now. All right, now let's talk about ULTY, which is the only basket of funds, the true ETF. So Yield Max Ultra Option Income Strategy ETF. Price as of recording is $5.48. Has about an 87.39% distribution yield with an annual payout of around $4.79. This has the highest fees at 1.14%. And the performance as of April, it's up 25% in total return since then, with the S&P only right around 16% since in the same time period. And ULTY is the poster child of high yield synthetic option ETFs. Huge income, constant NAV erosion risk, return of capital, all those things. I've done tons of videos on it. You can go look at them. But it's definitely one of the most popular or infamous ETFs of 2025 so far. Keep in mind, all of the data and visuals you're seeing came from Snowball Analytics. I use it to analyze my portfolio, track positions, and most importantly, monitor my distributions. I was a huge fan long before I became an affiliate, but since I started using Snowball, I've had more confidence and more control over both my investments and definitely my income. And if you want to give it a try, there's a free trial and a discount link in the description down below. I am an affiliate, so I will get a small commission, but definitely check it out. It's changed my investing perspective and career since I've signed up. So was a fan before an affiliate. So next we're going to run some scenarios. And if you want to run similar scenarios to these, I used marketbeats.com dividend calculator. It's free. They're not a sponsor, but it's a great tool to run scenarios and do quick calculations. So just to set up these scenarios, I stress tested each ETF with $1,000 drip on and assuming negative growth, yield decay, and NAV pressure. And here's what happened after 10 years. And just to keep in mind, I did a 3% annual decline for distributions and price for YETH, and I did 5% decline for HOW and ULTY. And it's just due to the popularity and high volatility of HOW and ULTY. Don't get me wrong, YETH is volatile too, but I just wanted to do the -3 and -5 to kind of even the playing field. Okay, so just ahead of time, these numbers might look crazy, but they are not out of the realm of what can be possible. So stick with me. So looking at YETH, the ending balance, $4.1 million. Total return is 421,000%. Crazy, I know. Average annual return is 130%, and the annual dividends is right around $5.5 million. And total dividends paid is right around 4.2 million, and yield on cost is 244,000%. So looking at these numbers, just to define, ending balance is after the 10 years, what would be my bank account? And then also annual dividends. It looks like that's more than total dividends paid. That's what I would make in year 11 in annual dividends. So just so we can clear that up before we go into the rest. Okay, now let's look at HOW. So ending balance here, $1.3 million. Total return of 132,000% with an average annual return of about 105%. Annual dividends would be 1.4 million with total dividends paid of 1.3 million. And the yield on cost would be roughly 71,000%. Insane numbers, right? But we're going to do a comparison. So that's more the most important part, relation to each other. So ULTY, the final one, ending balance, $95 million. I know this sounds insane. Total return is 9.6 million%. Average annual return is 214%. And the annual dividends would be $210 million. Total dividends paid, $97 million, and a yield on cost of 6.7 million%. So keep in mind, this is a 10-year scenario. I don't think any of you will be invested in this for 10 years. Plus, if you did, I don't think you would be dripping. I think you would be taking distributions, much like me, as income. So keep that in mind. Like, these numbers are just, if you just continue to reinvest. So I had to mention that for sure, because these numbers, they look insane. But remember, these are also modeled after negative growth assumptions. But the point here is to address the concerns about NAV erosion, price decreases, and yield decay. And even with those assumptions, it shows you the power of compounding high dividend with these stocks and then reinvesting those distributions. Like, compounding is unmatched, right? So that's why I also like dollar cost averaging. So let's look at the macro view. So if you're looking at just raw compounding, ULTY hands down dominates this comparison. YETH, it sits right in the middle with its massive yield, but ULTY definitely outperforms it. And surprisingly, to me, HOW lags in compounding, but it offers the best balance of NAV stability and income. So do with that information what you will. I really just wanted to run this scenario to see what it would look like. I'd love to hear your thoughts in the comments down below. What do you think of the scenarios I ran? What do you think? What would you invest in? Would you go ULTY, YETH, or HOW? Comment down below. Okay, so now that we kind of did that scenario comparison, let's talk about some of the pros and cons of these ETFs and maybe who they might be for. And this should help you get an idea if these even have a place in your income portfolio or not, or if you're just going to stay away, 10-foot pole, don't even touch me. So let's start with YETH. So some of the pros here, it's Ethereum exposure, plus you're getting weekly yield, you're getting paid weekly. And it's a regulated ETF versus holding Ethereum directly, which is in the crypto market, which can be difficult and confusing for some people. It's definitely volatile. So ETFs and stock markets are usually easier to navigate. Some of the cons, it does have a relatively high, but 0.96% expense ratio is not uncommon. And then you have the regular covered call ETF downsides, indirect structure, capped upside, and then it's a volatile underlying asset. So if you're crypto curious investor and you want exposure and you want income without owning Ethereum directly, this might be good for you. Now let's talk about pros and cons of HOW. Pro, huge growth, like exponential growth. Also comes with weekly income. Also is indexed to Robinhood, which is one of the hottest stocks this year. But on the flip side of that, it's only one stock. You're concentrated in one stock. So if Robinhood tanks, this will tank. So this is good for investors who want growth and income from, Robinhood specifically. If you really like Robinhood and you're bullish on Robinhood, this might be good to have in your portfolio if you want to generate income off of Robinhood. And then finally, ULTY, which this has the highest yield of about 87%. And like everything else, it pays out weekly. So you can actually generate a good salary for yourself. But it has the highest fee, so 1.14%. And it has shown the highest amount of NAV erosion and the most synthetic risk. So this could be good for income chasers who care about cash flow now more than long-term NAV stability, and maybe not looking for that long-term play, but just something that generates income today. So for me, I don't really see any of these as long-term plays. They, in my portfolio, they're engines to help me accelerate my dividend snowball. So right now, my largest holding is ULTY, but I'm slowly building up HOW and YETH because I use their high yield cash flow to fuel my steadier positions like QQQI, SPYI, and GPIQ. And that way I can grow my base of reliable long-term income funds much faster without relying on high yield synthetics. So can YETH outperform HOW and ULTY? Not quite yet, but depending on your goals, each one of these can serve a purpose in your portfolio. Again, YETH for crypto exposure and income, HOW for that exponential growth plus yield, and then ULTY for raw weekly income. So which one fits your strategy? Comment down below. I read everyone. I respond. That's me. I don't have anyone. I'm a solopreneur here. So it's going to be me. Keep the conversation going. Thanks again for watching. If you got value out of this, please give it a thumbs up and subscribe if you haven't already. I appreciate each and every one of you. And if it doesn't challenge you, it doesn't change you. Messy action is better than no action. Take care and I'll see you next time. Boom.